To begin with, my topic, I was actually assigned a topic. Where do we go from here? How do we make money with the bull market half over? The bear market is certainly over. What does that mean? It means that risk has increased. What is a bear market? A bear market is a set of circumstances where assets go on sale cheaply. We are trained, because we like to feel ebullient, that it's bull markets that don't have risk. Stocks go up for no reason, and every one of us, myself included, many times, loves confusing a bull market with brains. Bull markets are dangerous, bear markets are safe. So let's do this one more time. The bear market is over, risks have increased. Bear markets are simply a situation where goods are on sale. If we own goods, we hate the fact that our goods are on sale. But if we're consumers of goods, including financial goods, bear markets are great. I'm a pathological wealth seeker, which means that I consume financial assets. If I buy things, I want them cheaper, not more expensive. So, I'm going to get less gloomy in a minute. I want to talk about several aspects of the resource market in the context of the markets that we're in, and some of this will be familiar ground to those of you who have been to prior Casey conferences. Resource-based businesses, which is what we're all talking about today, are, as you all know, incredibly cyclical. My slogan with regards to cyclicality has been, you must be a contrarian or you will be a victim. The choices are yours. Hence, my love for bear markets and my fear of bull markets. It's interesting to note, and I want you to keep this in mind for the rest of this talk, that it's bear markets that cause bull markets, and it's bull markets that cause bear markets. What is a bull market? A bull market is prices escalating. The beginning phase of a bull market is the recovery from a situation where assets and stocks are so cheap that they can only go up. People are so discouraged, they're so disgusted, they're so dispirited that they don't want to buy anything. That's what a bottom is about. Coming out of the bottom, people just sort of figure out, some people, a few people, this is really cheap. The end of a bull market is where you have worn out the last buyer. The end of a bear market is where you have worn out the last seller. We're betwixt and between here. We are coming out of a spectacular bear market in resources. A bear market that I would suggest to you began 1981, 1982, probably didn't end really until 2002. And this was truly a spectacular bear market, a 20-year bear market, a market that cut through capital, it cut through capacity, it cut through people. Wonderful bear market. Things got so absolutely cheap that it was very, very, very tough to lose money. It's going to be easier to lose money now. We've lost our caution. Things aren't absolutely cheap. We've become more self-confident, and confidence is the enemy of performance. Terror is the friend of performance. Rational observation is the friend of performance. We're beyond that now. Another thing that it's very difficult for many people to grasp, and you need to grasp about natural resource-based businesses, is that these commodity markets and these equity markets are volatile, really, truly volatile. Volatility is different than risk. Whether volatility works to your favor or works against you is not a function of markets or a function of volatility. It's a function of you. What is volatility? Volatility is simply goods on sale frequently. That's all it is. When a market falls by 30%, what that means is that the market got 30% cheaper. It's up to you to decide whether to take advantage of the market's mistakes or get your information from the market that's making a mistake. When commodities and stocks go into hockey stick uptrends, people perversely tend to want to buy things that are becoming progressively and rapidly more overpriced. And when the prices decline, the price for the same asset gets 30% cheaper, people want to sell. Would you do that at a grocery store? Would you wander into a grocery store and be elated because the price of a can of tuna went from $2 to $3? Would you go to a grocery store and boycott them if they mark down tuna from $3 to $2? No. But if the price of a stock goes up overnight from $2 to $3 for no apparent reason, you're delighted and want to buy more. It's in an uptrend. This is wild. This is truly wild. And I guarantee you very few things, but this is a simple declarative statement. The next 5 years, you are going to witness volatility in these markets like you may have never seen before. It's going to be your choice whether you use volatility or you're used by volatility. They talk about now the trend is your friend. And they talk about participating in broad markets and not getting shaken out. I can see by the sea of gray hair in this crowd, and in fact, in some cases like myself, the sea of no hair, that many of you were here for the bull market of the 70s, the mother of all commodities bull markets. Of course, the price of gold ran from $35 to $850 by the end of it. In that great secular upmarket for gold, similar to the one we're having now, do you remember 1975? The price of gold fell by half. Price of gold fell by half. Am I saying it's going to happen now? No, but I sure wouldn't be surprised. So, to the extent that you are playing in a market that's no longer riskless, even though you and I believe it's going higher, remember that it can fall by a lot very, very, very quickly. You have to be psychologically and financially strong enough to stay the trade, or the same thing will happen to you that happened to many people in 1975. That is, they called the gold bull market right, but they didn't have the psychological stability and they were leveraged. And they went broke being right in the biggest bull market in history. So volatility isn't a risk, it's simply a condition. Whether you are a victim of volatility or a beneficiary of volatility is up to you. It has nothing to do with the market.